first, it's good to add some context on European gas price volatility. So there are several factors at play. We think there's a couple of headline risks that haven't really materialized, but seem to be influencing prices. So that would be, first of all, the ceasefire talks between Russia and Ukraine. We've seen some movement on the price on the back of announcements that this one of the routes where Russian flows went through Ukraine. One of those routes was actually sabotaged last week. That report was unconfirmed, but the price moved quite a bit. So that gave us a sense that there perhaps is some of that risk factored into the pricing at the moment.
I'm seeing so many conflicting headlines, Patricio. So on the one hand, I see that the German government has a new package for clean energy, and they're doing a spending push on that front. On the other hand, I see your analysis and some other things of this idea that there's perhaps a slowdown in renewables investment. So yeah, the government's saying one thing, the companies seem to be another. Read the tea leaves for me. What's actually going on?
China imports are down more than 20% through the first couple months. They've imported 50% less from the US. Obviously, they have a 15% tariff from them, and any contracted LNG they have with US, they're just redirecting to other countries. But you have, slower growth in the country. So lower demand for gas, you have higher storage, mild weather, and you're getting those increased pipeline imports and more domestic output. So they just don't have the need for LNG. But I think what that does is, because of the price arbitrage, it does, like Pat says, direct more LNG to Europe. 80% of US LNG has gone to Europe.
It was the first time we've seen the inventory of drilled but uncompleted wells rise in the last 3 years. And so that tally is 50% below peak levels from 2022, I should mention. But we've been, waiting for a bottom in shale activity for 2 years running now, or more than that. And, this suggests that maybe we're there. We saw, maybe a 20% decline in the rig count in 2023, another 5% thereabouts last year. We're kind of running steady. It's been stabilizing, 1 week up, 1 week down. But the productivity report, does suggest, and we did see an increase in the number of wells drilled. We've seen that number edge up.
Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence. On the call today, we've got Patricio Alvarez joining from his usual perch in Madrid, then swinging across the Atlantic Ocean. We've got Scott Levine joining from our New York City headquarters, 731 Lexington, and then Talon Custer joining from the greater New Jersey, New York City metro area. So let's hop straight into the research today. This morning, Scott, you've got an interesting note out titled "LNG Construction Pipeline May See Lift in Trump Administration." Tell us about what's going on with LNG.
Yeah, we initially did not expect major fundamental changes in the Trump administration and oil field services. In general, our view is that the activity levels are dictated more by fundamentals, supply, demand, commodity prices, etc. But we do think longer cycle markets that have more of a policy tie-in, where policy is more important, like LNG and offshore, could see more of a benefit from favorable policy developments. And the Biden administration implemented a moratorium on permit approvals, as Talon could probably speak more to, but we saw that essentially go away here with Trump returning to office, and maybe that drives more a pickup in activity levels in terms of FIDs and project approvals, and any relaxation of restrictions on permitting could accelerate that trend. And so we have seen a slowdown in construction activity over the last few years. Some of that has to do with the project pacing and just delays in general, not just on onshore terminals, but also in some of the floating LNG projects. But our expectation is that things, maybe pick up from here, and that could be a benefit to contractors like Bechtel and Technip Energies, Kiewit, KBR, Fluor, and the like. And so we updated our note there, and in that note, we included an association of Talon's updated project tracker, which includes a lot more detail on where we stand with all of those. And our hope is that we'll see some of these FIDs materialize in the second half of this year, if not early 26, and that could drive maybe an acceleration in growth and backlog for some of the contractors I mentioned, as well as some of the equipment suppliers like Baker Hughes and Chart Industries and the like.
Okay, thank you. There's a article from BN on the terminal this morning called European Gas Slips as Ample LNG Flows Help Ease Storage Worries. And Patricio, you've got a couple of notes talking about sub 30 euro natural gas in Europe. And just looking at the screen here at the moment, it looks like TTF's a little over 40 euros a megawatt hour right now. But what do you make of Scott's comments, and how do they feed into your thesis on European gas?
Sure. So I think first, it's good to add some context on European gas price volatility. So there are several factors at play. We think there's a couple of headline risks that haven't really materialized, but that seem to be influencing prices. So that would be, first of all, the ceasefire talks between Russia and Ukraine. We've seen some movement on the price on the back of announcements that this one of the routes where Russian flows went through Ukraine. One of those routes was actually sabotaged last week. That report was unconfirmed, but the price moved quite a bit. So that gave us a sense that there perhaps is some of that risk factored into the pricing at the moment. So talking more about the fundamentals, European gas storage is going to be roughly 30% full by the end of March. So just next week, it will be around 30% full. That is roughly that's almost 20% below what it was the same time last year. So there is a wider reinjection gap for the summer, that is for sure. And fundamentally speaking, we should be outbidding Asian buyers for a portion of that LNG, just given that only about 2/3 of Europe's LNG is long-term contracted. We always have to compete on pricing with for those spare cargoes. But that said, we've seen signs that Chinese LNG demand is not going to grow, or may not grow as analysts have anticipated. Roughly speaking, according to our analysis, we think Europe will import roughly 130 BCM of LNG, including Russian LNG, which you put that into the geopolitical mix as well. But considering that is roughly that increase is almost 25% upside this year. But at the same time, China was expected to grow roughly 5 to 6% on imports. But in February, LNG imports in China actually went down by double digits year over year. And that's because the power of Siberia, so Gazprom's pipeline, is running at full capacity towards China now. Not domestic gas demand has increased in China as well. And also demand hasn't picked up as expected. So all of these factors sort of point towards lower gas prices. And I don't think it's wild to say that they could go below 30, although it sounds like it versus the read that we have now. But that's based on the fact that we expect the global LNG supply pool, let's say, towards the end of this year to widen by about 4 to 5%. And I'm not trying to steal Talon's thunder on this because we used some of his analysis for this as well. But if we think about the fundamentals there, yeah, we think it's perhaps bringing forward this sort of expected increase in LNG supply, bringing forward by a couple of months perhaps. But again, that's very much exposed to geopolitical news and also the demand pickup in China.
Great, thank you. Talon, let's bring you into the discussion. What do you make of Pat's comments on, the dynamics around China, and how are you anticipating both sluggish Chinese demand and perhaps a potential for a Russia-Ukraine peace deal to factor into your outlook on LNG?
Yeah, Russia-Ukraine peace deal would. Yeah, that's where all the uncertainty lies, because if that happens, that completely changes the LNG landscape if more pipeline gas is able to go through. But ultimately, I feel like even if that does happen, we're looking at months down the road, maybe by the end of the year. And ultimately, I think, we're guessing here, but I think ultimately the only pipeline gas that may come back would be the Russia-Ukraine transit, which is about 15 billion cubic meters a year. Pat mentioned, like a 20 percentage point difference in storage. So there's different variables, weather, things like that. But if you add the 20 and 15, that's an extra, roughly 35 BCM of gas that Europe needs to bring in. And yeah, he's right about China. China imports are down more than 20% through the first couple months. They've imported 50% less from the US. Obviously, they have a 15% tariff from them, and any contracted LNG they have with US are just redirecting to other countries. But you have, slower growth in the country. So lower demand for gas, you have higher storage, mild weather, and you're getting those increased pipeline imports and more domestic output. So they just don't have the need for LNG. But I think what that does is, because of the price arbitrage, it does, like Pat says, direct more LNG to Europe. 80% of US LNG has gone to Europe, and that includes the UK and Turkey. But that's the figure we're looking at this year. And obviously, over the spring and summer, I think that stays elevated because Europe desperately needs to refill their storage. Without Russian pipeline gas, which I don't foresee in the next, few months, if at all, LNG is key for their country to reach their targets.
Can I ask just a quick follow-up question on China, because you were talking about some of the dynamics there. Now, my general sense is that China pays a pretty healthy price for the LNG that they import, aligned with Europe. Certainly, they're not getting Henry Hub pricing there. What are they using gas for in China? Obviously, China's well-known, abundant coal resources. And so, are they utilizing some of the gas that they import in power plants, or is it mostly more for industrial, residential purposes, that sort of thing?
I think they do use some for power. I think a lot of it is industry. Obviously I follow more of the broader LNG market as opposed to diving too deep into each one, but I think a lot of it is industry. Some is power. They have a lot of LNG trucks over there, LNG fuel trucks. So it's pretty much spread out, and it's such a big country. The power of Siberia gas comes in from the north, so it doesn't come all the way down. You have various of the coastal LNG imports, which need gas for that specific region. So definitely runs the gamut, but I think a lot of it is industry.
Yeah. Okay. Thank you, Patricio. Let's noodle on that same idea. Gas that's coming via LNG into Europe. What are the main uses? Is power a big driver still, and kind of what's your expectation for the dynamics in the power sector? And I'll also just toss at you, we do have a question from one of our clients who asked about potential for bringing Nord Stream pipelines back on, if you could comment on that as well.
Sure. So on the sort of gas demand split in Europe, I think a good way to describe it would be a pre-Russia-Ukraine war, which you could have almost split it, split it by three, like industry, heating, and power, almost evenly split. After the war started, obviously we've seen gas demand, especially in industry and heavy industry in Germany, decline by 20% plus since then. So obviously that has changed the mix, and we've seen also price, like the influence of weather and heating degree days or cooling degree days have a stronger influence on pricing since then, and also sort of a bigger drive from storage. So that tells us that most of the demand right now is being driven by heating, or the share used by heating is increasing, because on power, you also have other sources, dispatchable sources such as coal or lignite, which have reduced over the past, their shares over the past 5 years or so, but are still considerable. And also you have a growing share of renewables. So mostly weather and still a bit of power. And I think if we see a recovery in industrial activity, then that would be a vector for increased gas demand as well. In terms of the Nord Stream pipelines, yeah, I think that was something that was just reported with unidentified sources a couple of weeks ago. We've seen several European politicians sort of dismantle that idea. I think obviously there will be huge political backlash, I think, versus whoever wants to purchase gas from Gazprom through that pipeline again. There's also a lot of legal issues, I think, with that pipeline. Sort of the damages of it haven't been, like, there's no party responsible for the sabotage yet. There's arbitration proceedings over the multi-billion losses, and in light of that sabotage, and several European utilities have stakes in Nord Stream 2 and are in legal battles with Gazprom already over this loss. So legally, politically, it looks very improbable. Aside from the fact that it is sabotage, there is two tranches to the pipeline. Nord Stream 1, which was basically flowing at full capacity, bringing roughly 60% of the pipeline flows that we used to get from Russia, and Nord Stream 2, which was delayed. It took over 10 years to build. It was several million over budget. It was never commissioned, and half of it was also sabotaged in 2022. So there's only roughly 27 billion cubic meters available, let's say, or idle, that could be commissioned. But again, I don't think that's very likely, because who would be the buyer of that? And you need to untangle a lot of legal issues there.
Thanks, Patricio. This is probably a great place to advertise. On next week's call, we're going to have on a couple of analysts from Eurasia Group. So Gregory Brew and Herbert Crowther are going to join and talk about geopolitics and energy. Greg's quite focused on Iran, and Herbert's really got a China focus, but we'll make sure to ping them on Nord Stream as well. Patricio, just one quick follow-up before I come over to you, Scott. I'm curious, when you speak about the decline in industrial activity in Europe, what's your sense? Is that structural at this point? Or if the conditions were right, could we see some of that gas demand in Europe come back? And so in my mind, did the companies pick up and move to America, China, other markets? Did they re-engineer their facilities to use other fuels? So yeah, give me a sense of kind of how you read into that industrial landscape a little bit.
Sure, I think that's the multi-billion-dollar question, I suppose, for Germany. It's hard to say if it's structural, but I think in part it owes to the fact that Germany is very much an exporting-oriented economy. They're exporters, and their main markets have, China is their main market, and that we've seen demand weaken there. So that's, is that structural? I guess that would be the question. And the other one is, try to answer the second part of your question is, we've seen declines in power demand as well. So not only gas demand has gone down, also power. So that kind of answers the question of, okay, if there are substitutes, there is not enough flexibility on those substitutes to reduce energy costs. And obviously, higher energy costs are a barrier. German power prices are still around 90 to 100 euros per megawatt hour, which is twice as much as they were before the crisis. So yeah, even if we electrified heavy industry in Germany, it would still be very expensive on a relative basis versus places like the US and also China. So we've seen a bit of both. So releasing or lowering energy costs would release, I would say, the brakes on some of these industrial output and industrial activity. But again, it also depends on global demand as well.
I hear you, Ben. I hope Europe figures out their high utility cost. It's got to be holding back industrial growth in the region. Scott, let's come over to you. You've got some companies that have exposure to Russia. So we were just chatting about the idea of a Russia-Ukraine peace deal that could change some of the dynamics over there. So give us a sense of, how you think it could impact some of the service companies.
Sure. So, one of what we have come to learn, I think, because we started to hear rumblings about a slowdown in international upstream spending growth middle of last year, and it's become clear that that has been concentrated in a few countries, including Russia. And so what we saw a few years ago after the outbreak of hostilities was that two of the major oilfield service companies, Halliburton, Baker Hughes, sold their Russian businesses to the local management teams there. So effectively, they got out of the country. The other two major oilfield service companies, Schlumberger and Weatherford, remained in the country, however, indicated they would comply with sanctions, which has made it more difficult to operate there, obviously, and have also reduced their interest in growing their footprint there. And so clearly Russia is expected to decline as a source of revenue for both of those two companies, SLB and Weatherford. Not sure how much, but certainly, significant. We think double digits, safe to say. And so as the sanctions are lifted and as activity returns to the region, those companies would obviously be best positioned to benefit there. It'll be interesting to see if Halliburton and Baker Hughes return to the region. And then one other area where you could see impact is in the infrastructure contractors. Technip Energies, which is based in France, was the contractor on Arctic 2 and essentially had to exit the project in 2023 due to difficulties in complying with the sanctions on a large infrastructure project of that magnitude. And so Russia's been a key market for global contractors focused on LNG, and we could see that return as a source of growth potentially for the infrastructure companies as well. So, it would be good news, I think, for those companies, and the ones that have remained within the country have also faced some flack from the government for doing so and from investors in the media and so on and so forth. So that could lift one of the key overhangs that we've seen on the oil field services in 2025 comes to pass.
Very interesting. We've got a question from one of our clients listening about the relationship between natural gas and Russian fertilizer. Scott, I believe you might have, Talon, I believe you might have something to offer on the topic.
Well, I guess the one thing I would say is I don't know about Russia, but in India, a lot of the LNG that they import in India is used as a feedstock for fertilizer. So that's the first thing that comes to mind for that, but not sure what else to contribute outside of India.
Yeah, I mean, I think we'll have to circle back around. We do have a team that's very focused on ag, and we'll have on perhaps week after next one of our experts who can talk a little bit deeper on the sort of relationship between fertilizer, ag, energy complex. So stay tuned for that. We'll come back a little deeper there. Scott, I want to swing back around to you and move on from kind of the geopolitics Russia conversation and just note that I think you've noted there's been a little bit of pickup in U.S. drilling activity in the shale patch. So tell us what's going on there and how you're interpreting that.
Yeah, so we put a note out last week on the monthly EIA drilling productivity report. This is a monthly indicator of drilling and completion activity, as well as well productivity, that they report on a monthly basis. And we saw, really, it was the first time we've seen the inventory of drilled but uncompleted wells rise in the last 3 years. And so that tally is 50% below peak levels from 2022, I should mention. But we've been, waiting for a bottom in shale activity for 2 years running now, or more than that. And this suggests that maybe we're there. We saw, maybe a 20% decline in the rig count in 2023, another 5% thereabouts last year. We're kind of running steady. It's been stabilizing 1 week up, 1 week down. But the productivity report, does suggest, and we did see an increase in the number of wells drilled. We've seen that number edge up, generally speaking, since late last year. And we also saw the number of completions, or an indicator of fracking activity, hold steady. So, in order for the inventory of DUCs to rise, you need to have the absolute number of wells drilled exceed the number of wells fracked. And that's what happened for the first time again in quite a while. So I think we are seeing a stabilization in shale development activity, and that increase in the DUCs. We'll see if that continues going forward. Obviously, the data set does have some volatility built into it, but certainly it seems like we've reached a bottom in terms of the rig count, and maybe we're kind of bottoming in the frac count is what that suggests, but that maybe there's upside to what was expected to be a mid-single-digit decline in North American upstream CapEx in 2025. So good news, I think, for the U.S. focused land drillers, and to a lesser extent, the pressure pumping companies there.
Thank you, Scott. I want to swing back over to Europe, where the conversation is less about drilling and more about renewables. And I think that I'm seeing so many conflicting headlines, Patricio. So on the one hand, I see that the German government has a new package for clean energy, and they're doing a spending push on that front. On the other hand, I see your analysis and some other things of this idea that there's perhaps a slowdown in renewables investment. So the government's saying one thing, the companies seem to be another. Read the tea leaves for me. What's actually going on?
Sure. So yeah, let's talk about the second part first, because I think that that's been recurring since the start of the year. Is that investment in renewables among European utilities is going to slow down over the next 2 years or so. So several renewable developers have announced capex cuts in the region of 20 to 30% for the next 2 years, and that mainly is due to their exposure to the U.S. And it all revolves around policy uncertainty and the continuity of the Inflation Reduction Act. Also, the federal permit pause on offshore wind. So we've seen several developers just flat out say that they will not proceed with any offshore wind developments whilst President Trump is in office. So that's part of the story there. And the other part, I would say domestically, renewable capacity expansion in Europe is still going to be robust, still going to be, yeah, sounds strong, but it's not going to be as fast as it has been over the past 3 or 4 years. That's due to lingering supply chain issues, an overburden of bureaucracy and permitting delays. We've seen obviously a divergency in technologies. I think that's also very important to flag is offshore wind is still, I would say, it's still going to grow, perhaps mostly in the UK and more established markets like, well, the UK, Denmark, and parts of the North Sea. But other jurisdictions have struggled to set the right conditions for offshore wind development. The other one is onshore. Onshore has faced many hurdles due to, again, permitting tends to complicate many things. But then lastly, I think where there's a silver lining, I would say, for solar. Solar capacity in Europe and well in the US as well is going to grow rapidly again this year after beating records last year. And it's also important to note that it has exceeded most of the international agencies' forecast for demand expansion. Solar is outpacing most of these very ambitious forecasts. So there is a silver lining there. But again, the reason why utilities are investing less in these types of assets is because of higher interest rates, higher build out costs means that on a relative basis these are not the most attractive projects for utilities, because utilities can also invest in grid infrastructure which has a guaranteed rate of return. You get cost recoveries for debt expenses and also for inflation. So these are safer assets for utilities too, and you can see renewable spending sort of plateauing. And you can see that also in the German spending plan is 500 billion for infrastructure, with roughly 100 billion just put aside for climate. And that seems like a political concession for the Green Party that will probably have to support the forming of the coalition in the coming months. But there is very little detail on what that actually entails. We expect to see a bit of a more pragmatic approach, not renewables just because you want to build them, but perhaps, in the introduction of other technology subsectors. We think hydrogen will continue to play a role, especially in Germany, given their heavy industry focus, and also perhaps a bit more on carbon capture. I think those are the two things that will make Germany's new energy policy or upcoming energy policy a bit different from the past. But other than that, no, the story is the same. Germany will try to be carbon neutral by 2045. So we do expect continued support, and I would say the opportunity for renewable growth is still there, but perhaps we'll see a temporary slowdown due to these policy and supply chain risks.
Okay, thank you, Patricio. This is probably a good opportunity to just do a quick bit of advertising. On April 8th, I believe that's a Tuesday, Patricio and I and a couple of colleagues, including some of our friends over at Bloomberg NEF, are going to be hosting a webinar called Renewables versus Trade Wars. The battle isn't over. A little bit different than this discussion. We'll have some slides and a little bit more formal discussion. So if you want to go deeper on that topic, please do join us. Then I will also flag that yesterday, the tech team at Bloomberg Intelligence had a webinar on some of the latest developments on AI models. So there's this new tool out of China from Ant Group that claims to reduce cost and potentially energy use using Chinese semiconductors. They were kind enough to have me join and chat about some of our work on the topic. So the replay of that's available if you're interested there. And so maybe that's a fun topic to close out on. So for anyone who hasn't seen our work, we believe there's some potential read across from the AI revolution into energy markets. Basically, the idea is that there's a lot of investment happening in data centers to help fuel the AI revolution. Data centers use a lot of energy, and the build out of those data centers is occurring very rapidly. So, Talon, I want to just do a vibe check with you, because I know some of your companies have, talked about this idea on earnings calls and whatnot about the potential opportunity for gas to play a role in the meeting of power requirements for data centers, but give us a sense, what have you heard lately on that topic? Are your companies still discussing it when they do their results and readout?
They are certainly still discussing it. The AI energy euphoria continues. Still a wide range of estimates of what demand for gas will be through 2030. I've said this before in various forums that I think 2035 is a more appropriate target because 2030 is so close. It's going to take time to build all this, but a lot of the interest is behind the meter projects. Some midstream pipeline companies are getting into power gen. Williams, for example, raised their capital spending this year, and it'll be higher next year to try and deliver, the infrastructure to get gas, and also the power plant itself. Didn't say exactly where it was, but it's a behind the meter for, power generation for that type of project. There was, I believe, it was Energy Transfer with Cloudburst to provide power for a proposed data center. So still waiting on FID for that. But there's been, final investment decisions for different pipeline projects in the Southeast region aimed at providing, whether, some of it is for data centers, it is for increasing demand for power. So it's definitely still there. Always a hot topic in midstream is Permian natural gas egress. We had another final investment decision for the Hugh Brinson pipeline, which will take gas from the Permian to the Dallas area. And the idea is that a lot of that gas that they're going to transport may be used for data centers. That's going to come online, that I believe, at the end of 2026. So definitely the topic continues, but a lot of, behind the meter talk, pipeline laterals to get gas there, because we all know that the line, the queue for transmission is long. So I'll defer to you guys and see what you have to add to that.
Fantastic. Thank you, Talon. Just by the way, for anyone looking at the chat, I've put in the link for joining the April 8th webinar that Patricio and I will be doing. I also put the webinar from myself and all my colleagues on the tech team at BI from yesterday also in the chat. So take a look there if you want to either register for our upcoming webinar or catch the replay of the one from yesterday. Patricio, I know you've got some thoughts just quickly on AI and how it feeds into companies like RWE. So can you give us just a quick overview of your thinking there?
Sure, I would echo part of what Talon was talking about. So we still have mentions of AI across the utility landscape, I would say, especially for companies like RWE. So independent power producers like RWE, I think, are in a good position. So RWE, ENGIE, these are companies that have integrated assets. So they have a renewable development division, which means that they can deploy batteries and solar, but there's also a big need for dispatchable source, and these companies are pretty much geared to expand their gas-fired capacity over the next 3 to 4 years. If anything, that is part of the new coalition in Germany. So the German coalition plans to tender 20 gigawatts of gas-fired capacity. That means that they aim to roughly double the fleet that Germany has at the moment. Of course, there will be some sort of they'll phase out some of the old ones, but the tender is enormous. We do think companies like RWE and ENGIE are poised to expand their fleets by similar amounts, so nearly double that. I think the main question will be, are we going to build, or are they going to build this capacity only to cater for data centers? Probably not, but I think it is part of the story. Places like the UK, for example, National Grid in the UK expects data center power demand to increase by sixfold by 2035. And data by DC Byte, which is a provider that we have here at BI also, they expect most of the data center hubs in Europe to increase capacity by 2 to 3 times over the next 5 years or so. So the story is very much alive, but I think it will depend. It's hard to say which part of the incremental power demand will come from AI, but there's definitely evidence that there will be some marked increase.
Thanks, Patricio. Scott, I want to give you the last word. Give us a sense. I know your corner of the energy landscape may not have as much of an angle on AI, but tell me, is it something that you're seeing in discussions with your companies?
Yeah, no, certainly the contractors and the oil field service companies, have different vantage points in which to participate. The pressure pumping companies have dabbled in mobile fueling solutions. And this is an initiative that started to be motivated by e-fracking, electric powered fracking, and the conversion of the frac pumps to gas and electric as opposed to diesel. And then from the contractor's point of view, obviously, they build wind, they build solar, and, there's also increasing interest in nuclear as a longer term solution. They build gas-fired power plants. They build everything, basically, the infrastructure contractors, guys like Quantum Oztech, Fluor, Bechtel, et cetera. And, there's growing interest in this market, and I think it remains to be seen, what the fuel type mix ends up being, and renewables maybe a nearer term play, gas maybe an intermediate term play, and nuclear a longer term play. But regardless of the fuel type, infrastructure contractors should benefit from the build out of the power to support the growth in demand for AI. To support computing, and then to a lesser extent, I would say the growth in data centers as well. It's probably not as much of an opportunity for the infrastructure guys, but certainly the growth in power is. So a lot of excitement about the topic, and one which we'll continue to monitor.
All right. We'll leave it there. Thanks, everyone, for joining us this week. Hope you have a great rest of your week, and we look forward to seeing you next Wednesday. Take care. Cheers.